Hi, everybody. Good evening.
Yeah, we'll keep them. I agree.
Thank you for all coming. I love the connection we already made, and I'm really excited to meet everybody new and all the guests. I'm Alex, and this is Mark, and we just love to introduce ourselves for a second, and love having you guys here. And thank you so much for Lakeside, Raina and Casey. Thank you so much. Diana, thank you so much for having us and this beautiful location. So we just started about a few months ago, and I'm from the Salisbury area, and do mostly rentals and stuff like that. If you have any questions, please let me know. And a lot of questions to title company and Lakeside as well. And this is Mark. I'll let you introduce yourself.
Yeah, perfect. Hi everyone. I'm Mark. I'm based here in Annapolis. I'm a private lender. Also invest in apartment syndications passively as well. It's great to see everyone, and thank you so much to Lakeside for having us tonight at this beautiful venue here. I really appreciate it and excited for the conversation.
Yeah, so we're going to be talking about the LLCs and 1031. Get your questions there, if you have anything, or just write down. It's going to be great. So I'm going to just let you guys go for it. Thank you.
Hi, everyone. So I am Kathleen Guybeson, and it's actually Kathleen C. Guybeson, so that's where the KC comes from. But if you see my name as the agent for Lakeside Exchange, you'll see Kathleen Guybeson in all the documents. So I don't want you to be surprised. So just a quick poll here. Who has either done a 1031, been part of a 1031 exchange? Okay, we have a group of... I was going to say Marcy.
I was like, wait.
Okay, so this is a handout that I have, so because there will be a lot of things that I go over, and any questions you have, my contact information is right up at the top. Feel free to go ahead and reach out to me, and everything is pretty much covered on here. 1031s can be a little specific sometimes, so I think that it's good to, if you have a certain situation, just go ahead and give me a call, and I'm happy to go ahead and talk to you about them. The most important thing about a 1031 exchange is I am not the most important one. The CPA plays the most important role in a 1031 exchange. So if you have a client or yourself and you don't have a CPA who is well versed in 1031s and you want to do one, that is the time to get one. It's surprising. There are some CPAs who will tell you straight out, I don't deal with 1031s, that's not really my area. I think that when you start deciding that you want to invest in real estate, that you want to get a CPA who is very well versed in real estate investing and also 1031 exchanges. So where the 1031 goes ahead and comes into play is when an investor, not a principal residence doesn't count, when an investor goes ahead and decides that they want to sell a property, and oftentimes you'll hear, I want to avoid capital gains tax. You're never avoiding, you're deferring capital gains tax. And there is a chance actually to possibly avoid it. We'll talk about that. That involves your death, so you've got to talk about that a little bit. So what happens is you go ahead, put the place on the market, and whenever you go ahead, go under contract, you would go ahead and contact me. You can certainly contact me before you put it on the market. Anytime I can answer any questions, I'm happy to help. But definitely as soon as you go under contract. And you let me know you want to do a 1031 exchange. Key things with the 1031 is it has to be an investment property or a property that has gone ahead and produced income, or a piece of raw land that you've held on to. You want to have owned it at least a year, ideally 2. Ideally, you want to be able to go ahead, they call it with the IRS, safe harbors. You want to be able to show that you had rental income or that you've listed this property as an investment for 2 tax returns. And so sometimes when people talk about flipping houses, which I always say, don't say flip, say you renovate and quickly resell. what will happen there is sometimes those don't qualify for 1031 exchanges. And the reason why is you're going ahead and you are buying it, making the updates, and putting it back on the market very quickly. So because of that, that's considered to be ordinary income. So it wouldn't be subject to capital gains. So a 1031 goes ahead and allows you to go ahead and defer the capital gains. So the question becomes, do I want to do a 1031 exchange? The question is, do you want to go ahead and basically invest in a bigger and better property? And the reason why it becomes that way is you go ahead, you sell whatever the contract sales price is that you have sold the relinquished property for. So the relinquished is the one that you're selling. You have to find a replacement property that's equal to or greater than the contract sales price of what was sold. So for example, you sell something for $500,000, but you are only going to walk away from the table with, by the time you pay off the mortgage, pay the well-earned real estate commissions, all of that, you are going to walk away with $220. Well, I have people who say, okay, well, I found a replacement property for $250. That's not going to work. You have to find something equal to or greater than the contract sales price of what you sold. So the additional money can either be cash or you can get a loan. So if, using that example, you sold for $500,000, you want to purchase something for $500,000 or greater. If you can't find it with one property, it can go ahead and be 2 properties, possibly 3. There's a couple different rules that come into play as far as replacement property rules. So you have 45 days to go ahead and identify replacement properties. I tell people, if you think you're going to do a 1031, start looking for your replacement property as your relinquished one is going to closing, because 45 days will blow by and people ask me, well, can I get an extension? I was sick. No, the last time the IRS gave an extension on a 1031 was 9/11, and you had to go ahead and prove that you were one of the people who was involved directly, and even the extension was something like 2 days. I mean, it was nothing of any consequence. So that 45-day deadline, it's 45 calendar days. When you do a 1031, I calculate out those days for you. I give you all the information that you need. So there's 3 rules. 99% of the people will use the 3 replacement property rule. That is where you can identify up to 3 replacement properties regardless of value. That is what the majority of people are going to go ahead and use. Then there's something called the 200% rule. The 200% rule is, using the same example, you sold for $500,000. You can identify as many properties as you want up to $1 million. So 200% of what you went ahead and sold for. So in that situation, if you know that there's 4 properties that you want that are each around $250, that might work for you. In my experience, and I've been doing this 22 years, which I hate to admit because then I'm telling you how elderly I'm getting. I've had the 200% rule be used maybe 5 or 6 times over 22 years. Everybody else uses the everyone else uses the 3 property rule. Now, there is the 95% exception. That I've only seen used once. And that is where you can identify as many properties as you want, regardless of value, no cap on value, but you have to close on 95% of what you identify. The time that I did this, and in my experience, the client had gone ahead, sold a shopping center, and then bought 2 blocks of properties in Baltimore City to renovate. So that worked for him, but that was a very specific case. Like I said, 99% of the people are going to use the 3 property rule. So you go ahead and you can identify. What's ideal is you don't have to identify 3 because you already went under contract and you know what the property is going to be. That's great. The faster that you can go under contract, the faster that you can deal with things that could possibly come up that you might not want that property anymore. Up until midnight of the 45th day, you can go ahead and email me, change what those properties are. I like email because it goes ahead and gives a time and a date stamp. So in the rare event that you are audited, you have that backup information. Sometimes I'll hear stories about, well, other intermediaries go ahead and they allowed me to backdate. The IRS is not your friend. You do not want to go ahead and get involved in anything like that. So the key thing is you want to keep that deadline of the 45 days. Then after the 45-day deadline, you have 180 days to close on the property. That's usually never a problem. Where the 180 days comes in is sometimes people try and buy new construction, and that's tough. If they're telling you it'll be ready in time, as many of you have experienced if you've dealt with new construction, getting that UNO within the 180 days, it may not happen. And if it doesn't happen and you don't meet the deadline, you'll never be penalized for trying to do a 1031, but then it will be treated the same as if you would have sold the property and have never done the 1031. So I tell people, if you're really on the fence, you possibly want to go ahead and set one up instead of where I've gotten phone calls after the fact and say, hey, I closed yesterday. I found a great replacement property. Can I still do a 1031? After closing has taken place, you can't. That's it. So that's how that goes ahead and works. So does anybody have any questions as far as kind of how the process works, or?
You said that you can do like one property and 2 or 3. It's the reverse?
Yes. Yes. So if you have a couple of properties that you want to sell, again, just using rough numbers, you want to go ahead and you want to sell 3 properties for $500,000 and you want to buy a replacement property, as long as it's 1.5 million or greater, you're good to go with that. LLCs, which we're going to talk about more with REI, if it is an LLC, so somebody wants to go ahead and sell their property, the thing is there's something called the mirror image rule, which is however a property is sold is how it has to go ahead and get purchased. So if the LLC is 123 Main Street LLC and they're selling 123 Main Street LLC, 123 Main Street LLC has to buy the replacement property. The only exception to that is a single member LLC. That's a disregarded entity. So if you go ahead, you sell 123 Main Street, but you're a sole member, you can then purchase the replacement property either in your individual name, which I don't suggest, but you can, or in a new LLC where you're the sole member of the LLC. Where it starts to get tricky is when you have partners. You have members that make up the LLC, and one person wants to cash out, and one person wants to do a 1031. Those are the times where you really want to start thinking about, if you're going to put a property on the market, you want to start thinking about that months ahead of time so that you can go ahead and reset the holding periods. So when I talked about that, you want to be able to have held the property at least a year, ideally 2, that's considered to be the holding periods. So when you're dealing with the holding period, you want to be able to go ahead and make sure that if you're going to switch up the way that the membership interest is going to go ahead and be, ideally if one member wants to get out, you've got to find a way to cash them out, because the LLC is the actual exchanger. It's not the individual people, with the exception of if it's a sole member. Sole member, disregarded entity, so the LLC or the sole member is considered to be the same. But when you're dealing with partners, it becomes a little bit more complex.
Is that about having income producing? Does it matter how much income would be produced?
No, so it's got to be income producing in that it's either going to be a rental, it's going to go ahead and basically what they're looking for it is not going to be where you have a house at the beach and you rent it in February for 2 weeks. It has to be, so the property has to go ahead and can only be used from you personally for 10 nights out of the year. So that does not go ahead and include if you go down and decide to paint the place or make some type of repairs, but regardless, it's not a situation where you can have a ski place and you go ahead and you're there for the entire ski season, or you're there for the beach and you only rent it, in the dead of winter. That does not go ahead and count. So you've got to be able to, again, in the case of an audit, you've got to be able to show that maybe it didn't rent, but I had it listed with an agent and we did everything to market it to go ahead and rent, and it just didn't. But you have to be able to show that you attempted to make it become income producing.
So it needs to be rentable, occupied.
Or it can be a piece of raw land that you just have gone ahead and held on to, haven't developed, something like that. Or it could be an office building where you go ahead and even have an office for yourself. It's got to be anything but a principal residence. That's the thing. So it's got to be an investment property, which is what?
So if you're upgrading your principal residence from one to the other, and you want to defer the tax gains from your old property, can you sort of set it up as a 1-year lease for your old property, get someone in there, a renter in there for 1 year, and then sell it in 1 year post, sort of renting it out? Will that still sort of fall under the rules?
If you want to get audited real quick, that's going to, these are the types of things where you could go ahead and then you have an IRS agent, you have to explain to them exactly, what your thinking was, that you sat there and rented it to your mother-in-law for a year, things like that. There are some exceptions of how you can go ahead and handle it, but to be honest with you, there are other tax exemptions that go ahead and apply to principal residences. So 1031 is not really the way that you would go ahead and go.
Hold the property as a principal residence, not to pay capital gain. Does it be there for 2 out of 5 years or 3 out of 5 years, and you can just sell it?
If it's your principal,
Two.
2 out of the 5 years.
But also you have to pass the occupancy test, the ownership test, the residency. So it's all free.
Exactly.
Yeah, 2 out of 5.
There is
The military gets 15 years, 2 out of 15 years. So just so you know.
Yeah, so that's something that goes ahead and comes into play. Yeah, so you can go ahead and you can think about that. So that's pretty much how the 1031 exchanges work. I always tell people, go ahead and call me as far as what your specific situation is, what you're thinking about doing, what you can possibly do, what you can't do. And the CPA, you always want to talk to your CPA, because your CPA is going to be the person who knows what your basis is in the property. Your basis is equal to what you paid for it minus depreciation plus any improvements. So your CPA is the only one who's going to be able to tell you what your basis is based off of how aggressive schedule they may have sat there and taken with depreciation, things like that. So also your CPA may tell you, and I may tell you the same thing, you know what? Depending on what you want to do, a 1031 may not be the best situation for you here. Based off of what the market is and you really not interested in any replacement property, that maybe you just bite the bullet and go ahead and pay the taxes on it rather than, because what's happening is you are not avoiding the taxes, you're deferring the taxes. So when you sell the replacement property, you're paying the capital gain on that plus the capital gain that you just deferred. And what you're kind of gambling with is you're not sure what is the tax rate going to be at that time. Now, what I mentioned before, there is one way to avoid capital gains altogether, and that is called the swap until you drop method. And that is where you go ahead and you 1031 properties. So you go ahead, that next replacement property, you're ready to sell it, you go ahead, you 1031 that again. roll over the capital gain from the last two into the next one. Then you die. When you die, your heirs get a stepped up basis, and that's where the capital gain goes ahead and goes away. So if you can afford to continue to be invested in real estate, that's the ideal method to go ahead and go with. Helps you go ahead and avoid the capital gain. Yep.
Can you explain the stepped up basis? Does that mean you're basically saying all your taxes?
The stepped up basis becomes, so rewinding for a second, your basis in a property is equal to what you purchased it for minus depreciation plus improvements. Okay, so let's go ahead and go back to our example. You bought a house, $500,000, you made improvements, took depreciation over years, now your basis in it is $320,000. But you meet an untimely death, your heirs get a stepped up basis which is equal to the fair market value at that time. Fair market value, you bought this for $500,000, could now be $650,000. And then that's where there's no capital gains. If you were to go ahead and sell it, it would be where you would probably want to 1031 it, because you would be looking at the difference between the $320,000, which was, you know, the basis after the depreciation plus the improvements, and the $500,000. But, you know, again, there's only two things you can count on, right? Death and taxes. Well, something goes ahead, happens to you, your heirs get a stepped up basis. This is usually long-term thinking as far as real estate investing, that if this is a game that you want to go ahead and get into, you want to look for the long term of how long am I going to continue in investment properties. If you want to be able to cash out at some time, you're probably really going to look at capital gains. But that's why you want to have the conversation with your CPA. It's good to have the conversation with your CPA right at the beginning saying, I think that I might only want to own some investment properties for a while, and I think I might want to cash out for my children for college or for whatever reason. And because of that, I don't want you to take a super aggressive depreciation schedule, things like that. So I know this is a lot of information. That's why I tried to sit there and give you a handout that went ahead and went over everything as far as the steps to a basic, 1031 exchange, the number of properties, how they can be identified. The next case is, the purchase of the replacement property. So let me just give you a quick overview how it goes ahead and works. You go under a contract for the sale of your relinquished property. What happens? You go ahead, you call me, you send me over the contract, and it would be great if you or the agent had some clue where the buyer is choosing to go ahead and close. It's wonderful if it's lakeside. It certainly does not have to be for a 1031. And then what happens is I contact that title company. I tell them how they have to adjust the settlement sheet to show that you are not walking away from the table with money, that money is going to go into a 1031 account. This is helpful so that your settlement sheet for the relinquished property and the replacement property, you're going to take both of them to your CPA when it comes time for you to do your taxes. So I go ahead, coordinate with them. I give you a W-9. That is, again, God forbid anything would to happen to you, it would be that the money that is in the Lakeside account, there's a sub-account that's set up for you, would be the money that is set aside for you. Will go to your estate if something were to go ahead and happen to you. Then what happens is closing, instead of them giving you a check at the table or asking you where do you want wired, I've already sent them all the documents plus the wiring instructions. With the way fraud is rampant, we are very good about going ahead, double checking, triple checking, wire instructions, all of that. They wire the funds into that sub account. So it's a Lakeside LLC account for the benefit of the exchanger. That money then sits there until you go ahead and call me and say, I found that replacement property, here's the contract, this is where it's going to go ahead and close. Then I go ahead and make sure that the money is there for closing. Then there's another bunch of documents that get signed there. Property does not have to be in Maryland. You can certainly go ahead and sell something in Maryland and buy something anywhere in the United States or US territory. So Puerto Rico, U.S. Virgin Islands, they all count. So you're not limited. I've handled 1031 exchanges that are connected to Maryland, and then through people, I've handled exchanges where people sold in Florida and bought in Oklahoma. And somehow I've handled those exchanges. So it does not have to be a situation where it's connected to Maryland, connected to Delaware, connected to, you know, the area overall. Yes?
So how are you paid? Where in that process?
So we go ahead, Lakeside Exchange collects its fee on the settlement sheet for the relinquished property. So you do not have to go ahead and come out of pocket for anything. It will get 1031 treatment, so it's money that will go into your 1031 account. It goes ahead and gets paid on that settlement sheet, and that way, that's how it goes ahead and handled. The majority of investor 1031s that I do, I charge a fee of $1,250. It's a one-time all-inclusive fee, meaning that I don't do copy, FedEx fees, things like that. Sometimes what you'll find is there'll be other intermediaries who say, oh, we only charge $600. Well, they charge $600 each side, then charge you a copy fee, this and that, and the next thing you know, you are much higher than if you would have gone ahead and gotten an all-inclusive fee. The only time where I end up having fees that are higher than that is when I get involved in the really large exchanges. Like I said, I had a shopping center that was $66 million. I did not charge $1,250 to handle that exchange. That just, you know, gets a little bit more complicated. You have 15 attorneys involved and 5 CPAs and all of that. So that's when it becomes more complicated. But like the standard, you know, $1 million or less, I charge $1,250. One-time fee, goes ahead, like I said, gets collected on the settlement sheet, so you don't have to go ahead and come out of pocket.
And so you serve the whole country? So
Anywhere in the U.S., anywhere in the United States or a U.S. territory. So you can do 1031s any of those places. All right, let me make sure I covered everything. I think I did, and then any other questions that you have. Oh, I talked about boot in here. So you go ahead, using our example, you sell for $500,000, you are going to walk away from the table with 180, using the example of that, your basis came down to 320, and you decide of that 180, you want to go ahead and take $50,000 and go on a great vacation. You can go ahead and take cash out of the 1031. You just have to go ahead and report that as what's called boot, and you have to pay capital gains on that portion. 1031s are not all or nothing, where it used to be if you didn't take all of the money and it didn't all go into the 1031, it was disqualified. No, here you can go ahead and take cash. You just have to make sure that you report it on your tax return and going to go ahead and pay capital gains taxes on that cash that you go ahead and take. Here, I went ahead and mentioned a couple things that get a little bit more advanced topics where it gets into the 1031 fees and closing costs, what's eligible for 1031 treatment, and there's something called opportunity zones. These things are just like a little bit more complicated, but if it's something that you want to talk about, certainly go ahead and give me a call. The 1031 fees and closing costs, 1031 fee goes ahead and gets treatment. 1031 treatment applies to any commissions that are paid. The only thing that doesn't count for 1031 treatment is any fees that are paid associated with the loan. So on the replacement property, if you go ahead and you take a loan out for the additional money that you're going to go ahead and owe, that anything that you have to pay that is a loan fee, that's considered to not be part of getting the property. That's considered to be part of getting the loan. So that doesn't get 1031 treatment. But in general, if you follow the rule of thumb that any replacement property is equal to or greater than the contract sales price of what you sold, you'll go ahead and defer all the capital gain. You won't go ahead and have any problems.
I have one question.
Sure.
So I know you have 45 days to identify the property. You go under contract, you have an inspection, it's a horrible structural problem, whatever, you decide you're not gonna buy the property. Does that 45 days start over, or are you still within that? It has to, the unit.
It has to be, that's why you want to go under contract and be able to do those inspections as quickly as possible, so that if you do find a disaster, you can go ahead and you've got time to find another replacement property. Catch-22 on whether or not you let people know that it's a 1031. You don't have to disclose when you're putting in your offer. Sometimes it helps you get the property because people know that you have to go ahead and you have to have a replacement property. Sometimes it does not help you get the property at the best price because people know that you have to find a replacement property. So that's one that with your agent you want to kind of discuss whether or not you want to go ahead and disclose that it's going to go ahead and be a 1031. You can afterwards go ahead and put the addendum in the offer, but you know, starting, some people right from the beginning when they go look at the house say, I'm doing a 1031, it's important that I find a replacement property, my deadline is coming up, this is what it is. And like I said, that can go either way. Sometimes it's helpful, sometimes it's not as helpful, so that's always a good conversation to have with your agent, and especially with what the current market conditions are, what you're going to decide. Yep.
What if you buy a property subject to that another investor has 1031?
That's not, I've had 1031s where they're on both sides. That's not. So you're going ahead, you're selling a property, it's your relinquished property and it's their replacement property, no problem. You're going to have an intermediary on both sides. So that happens a lot, actually. So that's not an issue. That won't impact the 1031 for you.
Okay, and how does the seller, how do they get taxed? Do they, because you're not letting the bank know, right?
I think it's a complicated question.
Yeah.
Everybody knows, I mean.
Yeah, the 1031 goes right on. Now, you go ahead and when you're applying for the loan, you're letting the bank know that you're doing a 1031. And what I provide, I call it the 1031 money letter. They're going to ask for proof of funds from your 1031, so I write them a letter going ahead saying that this relinquished property closed on this date, and on this date we received a wire for X amount of money, and that goes ahead and allows for them to be able to, go ahead and give you the loan based off of the financial information that's being provided to them. And it's always helpful when you give them a copy of your settlement sheet where they see that the amount of money that is in the 1031 account matches what was on the settlement sheet. All right. Sure.
So you touched upon LLCs being sold. Let's say it's a multi-member LLC, and that LLC will be dissolved right after the property is sold. And if one member wants to go for a 1031,
it doesn't, the LLC continues on if the multi-members choose to. So typically what happens, you have a multi-member LLC, and again, we'll say that it's mom, dad, and son. And they, you've got 3 members of the LLC, and they go ahead and they sell the property. Well, then their LLC will go ahead and purchase the replacement property. Where it comes, so each LLC has an EIN number, which is basically like a social security number for the company. Where it comes into play, where I have people kind of get nervous, they're like, I just sold 123 Main Street, and my LLC's name is 123 Main Street. What's going to happen? Well, you still have to purchase it as 123 Main Street, but then you can do articles of amendment to change the name. That's fine, because the EIN number stays the same. So I equate that to people who change their names after marriage. Your social security number stays the same. You're still, well, there's a debate if you're still the same person after marriage, but you're the same person. You're the same person, same social security number, just your name has gone ahead and changed. So with the LLC, you can certainly go ahead. Sometimes people want to then form a new LLC to purchase the replacement property, and you can't do that. All the members should stay. If they choose not to, so for that example, mom, dad, and son, son decides I don't want to be part of it. Mom and dad would have to cash out son so that the LLC would still be purchasing the replacement property, just now it's just mom and dad are the members. Basically, the IRS looks to see that the entity that sold is the entity that purchased. They don't really care about what the membership makeup is.
Thank you.
Oh, you're welcome. Any other questions before we dive into the wonderful world of LLCs? Oh, real quick, before Raina goes on to that, I talked about like-kind. You'll hear 1031s called like-kind exchanges. Just know that it's real estate for real estate. Up until a couple years ago, there were other items that could be 1031 exchanged. So you had where people would do 1031 exchanges with airplanes and with cattle, and you would get into what was like-kind, and there were rulings from the IRS that male cattle was not equivalent to female cattle, so that didn't count, things like that. Real estate for real estate is fine. So if you have a condo in the city and you want to sell it for a piece of raw land, that's fine. It can be a place at the beach that then you're going ahead and you're trading for an office building. All of that is fine. The other thing to mention very quickly is if you really cannot go ahead and find a replacement property, I certainly have contacts. I'm sure some of you have contacts with what's called Delaware Statutory Trust. And those are where you purchase a tenant in common portion of a portfolio. So there will be a portfolio, say, of shopping centers in Minnesota, and you would go ahead and purchase for $220,000 the 0.012% of this portfolio. So there's always the option of going ahead and with Delaware Statutory Trust, going ahead and investing that way. So if you can't find a replacement property that you like, you can't buy stock, but you can buy what they call tenant in common interest in these Delaware Statutory Trusts, and that's always an option.
So you couldn't, I'm just curious then, so say you have a condo at the beach, you couldn't buy a co-op in Baltimore City?
Yes, you can.
You can?
Co-ops can get a little difficult, but you can 1031 a co-op. In general, you cannot buy stock, but because the stock certificate is equivalent to a specific unit, co-ops do go ahead and count. Yeah. Did you have a question?
On a similar point, so you could go from a direct investment to picking up something that's through a syndicate.
Like a REIT, maybe?
A REIT or a syndicate.
That's-
It doesn't matter.
Right. So
Right.
So REITs don't count for 1031 exchanges. They specifically have to be in Delaware Statutory Trusts. The Delaware Statutory Trusts operate very, very similar to REITs. So that's what will go ahead and happen. And I've done a significant amount, not so much with an individual investor, but when they start getting into selling shopping centers and things like that, that's when they will go ahead and purchase in Delaware Statutory Trusts when they can't find something specific. And then instead of being invested in one property, you're invested in a variety of properties. So then that goes ahead and allows for you to kind of diversify what you're investing in.
And you said that's syndicate, right? So syndication counts as well, or not?
As a limited partner into SPV.
You want to go ahead and stick with the Delaware Statutory Trust. Those are the ones that have been approved by the IRS, so that's what you want to go ahead and look at for the replacement properties.